Doesn't matter if it's the regulatory body in Canada. It doesn't matter if it's the United States. These things are going to continue no matter what. In all of the countries, these are the same risks that are going to come. We have this agency in Canada called OSFI, or Office of the Superintendent of Financial Institutions. Like, what is that? This is just the regulatory body that looks after the banks and makes sure that you and me are okay. Now, every year they come out with this whole document outlining the risks. And it doesn't matter if you're in the United States, it doesn't matter if you're in Canada. The risks that they are outlining is basically everything that we're talking on the channel about all the time. But I wanted to show you in this concise article, and I read it so you don't have to. So we're going to make it a little bit easier on you today. All right, so the OSFI's annual risk outlook is for the year. The ARO, they love their letters, right, for everything. And they have a whole whack of risks that are there. Now, you guys are not going to be very surprised by any of them. Number one, given the rapidity at which the interest rates globally have increased, the risk has grown that such an adjustment may not be completely smooth. Now, you guys know that I've been saying this for a long time, that there is something called a lag effect. When you raise the interest rates, it can take about 18 months for that interest rate to have a full effect on the economy. So we've only been raising the rates for 12 months. So we are not even having the full effect of the first interest rate hike, let alone all the other ones that we've had so far. If we continue on, they say geopolitical risks continue to contribute to market volatility and security of the financial sectors. Yeah, well, duh. There's a hot war in Europe right now, which we haven't seen before. China wants to pull away, the BRICS nations. So yeah, I think that's massively understated if I was going to say that. Now, they're saying they're going to try to increase their safety buffers. As you know, if you just go to the OSFI, they're going to tell you what their domestic stability buffer is at 3%. Now, we did a whole story on that. We can link that up above. This is where if you have $1 million, just let's say as a mortgage a bank has, they have to put 3% aside as a rainy day fund, like $30,000 put aside, tucked away, liquid, so that if there's ever any kind of liquidity squeeze, they got some money to bail themselves out. All right, so let's continue on there. If we continue on, they itemize the 9 risks, but here is the very number one risk. Number one, okay, I can't stress that enough. Number one risk is housing. Now, the Office of Superintendent, it says it's preparing for the possibility of the housing market will experience continued weakness throughout 2023. So as you know, last Christmas, they upped the domestic stability buffer from 1% to 3%. So we knew that, right? We were expecting very weak for 2023. Most of you who follow me saw me that last spring, more than 12 months ago, I was saying, sell your homes, sell your homes. I've been saying that for the past year. And homes in Toronto were dropping at $10,000 a week. Absolutely crazy. So the steep increase in interest rates has eroded debt affordability. People can't afford the homes anymore. They can't qualify for the loans. This is a growing concern. It continues from a prudential perspective. Mortgage holders may not be able to afford continued increases on monthly payments or might see a significant payment shock at the time of their mortgage renewal. So that is 2 parts to that. If you notice, I also did a video before when we were talking about Bank of Montreal and CIBC, where a year ago, they had 0% of people at 25 years on a mortgage or more as amortization. But recently, we now have mortgages that they're now 25% of people are over 35 years because the banks are extending the amortization to make them have that home price. Now, this is the lag that is number one that they're talking about. Number two is that effect of the default. If you had a $1.5 million home a year and a half ago, and now the home is worth $1 million, now all of your equity is gone. You will not qualify for a new mortgage when it comes time for renewal. And that sticker shock is going to hurt a lot of people. Liquidity, like loans, are even tighter now. They want even higher credit scores, higher incomes to qualify. So this is going to push it down the road a while, but then there's going to be a tsunami of homes that come on the market, and that's going to drop prices. Just so that we can make sure that we're clear on that. It has eroded debt affordability. Yes. It says mortgage holders may not be able to afford continued increases on monthly payments. That's what we said. They've been extending their amortizations up to 35, 40 years, and they'll see a significant payment shock at the time of their mortgage renewal. This is exactly what we were just talking about. This is very, very dangerous. Now, they're talking about their lending standards, but that is just tightening the amount of lending that is out there. Higher credit scores, higher incomes. The remainder of our review of B20 will examine other areas to enhance credit quality and sound mortgage underwriting. Okay, let's translate that. That means higher credit scores, higher amounts of dough. So in 2012, when we were in a credit crunch, you have to remember I had friends that owned several homes, free and clear, zero mortgage, high income, credit score 800, and no bank would give them a mortgage at all, even 50% on their homes, let alone 80% loan, not even 50. The banks are not lending. And in history, this is very common, but in recent memory, everybody seems to forget this. They always believe that money will always be available, and it is not. All right. Number two, liquidity and funding risk. So this is, where do you get the money if you want to buy a house? The bank has to make it for you. So liquidity and funding conditions will come under pressure as financial markets absorb the impact of monetary policy tightening, geopolitical uncertainties, that's the war, and retrenched risk appetites of market participants in less certain economic conditions. All right. So this is going to what we're saying. It doesn't matter if there's a lot of people that want to buy homes or don't have homes. If they have no access to credit and they cannot afford anything, there's nobody to buy it. And in Canada, the way it works, almost nobody owns their home free and clear or buys it free and clear in cash. So this is, you need to have a mortgage. You need to have liquidity or money available at the banks for people to borrow. Now, it says asset repricing associated with rapidly rising interest rates and equity market downturns can also put downward pressure on the value and marketability of liquid asset holdings. Whoa. Okay, this is a massive amount of information in one sentence. Okay, so take a look at that again. Okay, it says that asset repricing. So your home dropping from 1.5 million down to 1 million, asset repricing associated with the high interest rates. Okay, that's what caused the homes to drop so much in value, and equity market downturns. So that means all your stocks at the same time have gone down, are putting that pressure on the market. So that's a big problem. Yeah, when your home drops from 1.5 million down to 1 million and your stock portfolio has dropped by 30-40%, where are you? I mean, if you were in tech, now you're down 60-70%. So now you're losing from every direction. And they're saying that is a massive risk. But guess what? This is what's happening right now. It continues, unexpected liquidity demand can rise from sudden increases in derivative collateral calls. So that's like a margin call. We talk about that all the time. And significant changes to borrower and depositor behavior. Of course, so when people need money, they're going to borrow more, but they become to be more risky when they're right near the end and their back is pushed up against the wall. This is the last part that I wanted to bring up on this subject. As financial systems digitalize, so, there's a lot of things that are digitalizing right now. It's going to come right back down to what the lawyers use. And as far as underwriting, speed and amplitude of investor and depositor reactions on both environmental and idiosyncratic stresses will intensify. Well, we know there's going to be more and more troubles. Okay, I did a video yesterday, you guys, on commercial real estate risk. I want you to go take a look at that video because we are used to seeing stuff that's happening in the residential space where properties could drop 15, 20, 30%. We're seeing even some outliers at 50%. But when we get into commercial properties, now we're seeing some crazy numbers, 70, 80%, like big numbers in commercial. We did a video on that. I'll link it up above for you to look at that too. So it's saying hybrid work arrangements is a big problem. People working from home, reduction in staffing levels are likely to affect demand and over time have a negative impact on office asset valuations. Well, I'm saying it's already here. This is already here. And it says there's uncertainty in the coming year. Well, I'm certain that it's going to continue to hurt. So what are they going to do? These banking regulators, we're going to conduct targeted monitoring. Okay, keep monitoring, you guys. All right, I'm going to skip down. Credit risk. That's another one. But they're saying the same thing for multiple things. Corporate and commercial debt is very high. And of course, they're saying, geopolitical tensions, war overseas, supply chains, blah, blah, blah. So that's a risk. Digital innovation risk. Now, this is stuff that we talk about, we've seen on the news, where it's talking about FTX, it's talking about Celsius, Terra Luna, all those cryptocurrencies that are going under. But wait, they're saying that there's also some big booms that could take away a lot of jobs, like artificial intelligence, for example, and ChatGPT that is out. Now, we're seeing digitalization of a lot of different things. If you go to atlanticcouncil.org, you can also see the number of countries that are involved right now in trying to launch a central bank digital currency. They even want money, no more cash. They want to have a record of every single thing that you purchase. And so there's risks with this as it goes on. So there's pros and cons about central bank digital currencies. I also have a video on that. We can link that video for you to look at central bank digital currencies. That's very, very important for you to understand what's happening right there. The United States is launching in July 2023 is the Fed Now service, which is a ledger service, which is basically based off of crypto or Bitcoin, like a distributed ledger technology for your money. This is the payment rails for it. So this is coming for us. We have to make sure that we know what's actually happening. Climate risk. We know that there's a climate risk that's out there. They need a lot more cash in order to buy stuff. Unfortunately, as the baby boomers are getting older, they're pulling their money out of risky investments like climate investments, and they're putting them into safer things, especially nowadays when you can get a type of treasury close to 5%. They're not going to take that added risk right now, especially since they have no time to recover. Cyber risks, obviously, that's a big one, people getting hacked. But these are the main things that I want you to look at. So this is the Office of the Superintendent of Financial Institutions. So this doesn't matter if it's the regulatory body in Canada. It doesn't matter if it's the United States. These things are going to continue no matter what. In all of the countries, these are the same risks are going to come. Now, probably the first risk, even though they had residential housing there, probably to me, the very first risk is commercial real estate. Now, normally commercial real estate, it renegotiates itself at shorter and shorter times. In the United States, it's probably close to 2 trillion. In Canada, it's not as high, but it's a very, very significant part of the market. And so the swings in interest rates actually compound themselves onto commercial real estate. And I'm seeing a lot more blood on the streets when it comes to commercial than it is in residential. Right now, residential real estate, because of Silicon Valley Bank going under, the mortgage rates came down. And so when mortgage rates come down in conjunction with the spring market, I mean, it's going crazy. So if you were thinking of selling your property, I mean, this is an amazing time to do so, especially if you have a property that had a problem with it, like say it wasn't very nice in the inside, needed a renovation, or you were underneath a power line or by a power line, or you were on a busy, terrible street or near like something that most people wouldn't like. This is an opportune time to buy it. Low inventory, huge demand, a lot of buyers out there. So this is the perfect time to sell a property, especially if you had some kind of thing that people don't generally like. Anyway, you guys, my name is David Ruff, and I operate as a broker in Toronto, Canada. You can always reach out to us if you have any questions. And if this helps you at all, please consider liking, please consider following, sharing it with your friends. And, you know, I always say the next 2 years is going to dictate the next 2 decades of your life. So be careful. We're here for you. I hope that you have a great day, and we'll talk to you soon.